Hello, everyone. Welcome to a Wall Street for Main Street podcast. My name is Mo Dawood, alongside John Manfreda and Jason Birek. And today we're going to discuss the 2012 in review, and then we're going to do an outlook for the year 2013. So, guys, how you doing? Happy New Year.
Happy New Year, everyone. And 2012 was a very unique year, if you ask me. If you look at it, we had QE3 and basically QE4, but that was in December. And despite that, gold was up a little. It's sort of correcting now. Silver has remained flat, and oil is down. It started up really high. I think it corrected then. Just tensions came down, money being hoarded on the elections. And after 79, it had a nice bounce back. And the funny thing is, despite it going up from 79 to 93, the rig count's still dropping because there was a lot of rigs at 100 that are no longer profitable at these low prices. So, very unique year. What do you all think?
Yeah. First of all, hello guys, because I didn't get a chance to say hello to everyone there. Hopefully everyone's 2013 is better than their 2012. In terms of investing related stuff, yeah, I mean the general stock market, actually went up. It went up in nominal terms. Make a debate whether or not what the real inflation rate was and if the general stock market kept up with the real inflation rate. But a big question that I have, and I keep hearing a lot of people predicting this, is it seems like every year after 2008 when the market crashed and then the market rebounded based on TARP and the bailouts and the QEs and then the mark-to-market accounting laws were changed for the banks, is that people keep predicting the market to crash again, in fact even lower than 2008 levels. And the question then is, how's the general stock market, the Dow, the S&P 500, those types of things, how's it going to act going forward? And, you guys can weigh in on this, but I think we're going to have volatility. I think that's for sure. But I also think, the market could crash, but there's just so much free money that's being given to all the Wall Street banks, to all the hedge funds and speculators and the large banks and stuff, that it seems like any time a stock corrects, any of these dividend stocks with yield, general market stocks correct, and it could trigger, a cascade waterfall decline or something like that, just big money comes in and buys it up on the dip.
I agree with that as well. And I've seen a lot of experts out there predicting another crash, and it never happened, mainly because the Federal Reserve are intervening in the economy and making sure that there will never be another stock market crash like 2008.
Because what the banks are making, what the banks are, if they mark their balance sheets right to market, they're insolvent, but yet they have record profits now. So the bank stocks like Bank of America during this past year in 2012, Bank of America was up over 100%.
Yeah, and yet I talked to Christopher Whalen, which is one of the best banking expert out there, and he said Bank of America is in bad shape if you look beyond their record profit. So it's kind of ironic that they're...
I was going to say another thing is people forget in 2009 they passed a new law. They passed a law in March, and they're allowed to just revalue any asset at the price they want. So they're allowed to completely, just basically lie on their balance sheet legally. So that can always keep their balance sheet sort of look decent, when in reality it's in really bad shape. Example is houses that are owned. They can revalue them at any value they want instead of the current market rate. So that creates their asset to liabilities ratio much higher than it normally would be, or their debt or their assets. That's one thing. And I do think just the central banks printing money, they'll allow to that won't create a stock market crash. One thing I am impressed with, I know this is unusual to say, but the Federal Reserve lately, they won't be able to do this for very long, but they are doing a good job of controlling inflation because it is going into the stock market. The past year, not much of it's gone into metals or oil. Eventually, it's going to really hit metals and oil. I don't know when. It'll just happen when it does, in my opinion.
Well, yeah, the Fed has done a good job of managing inflationary expectations here in the United States, and that's not all the Fed's credit there. The normal transmission mechanisms, which create inflation, normally happen in the banking system, which are through, banks giving out loans to real Main Street businesses, growing jobs, and then the people, when they have more money from new jobs, go and spend the money, either reinvest it in business opportunities or spend it on consumption. So the normal lending and spending mechanisms are not really the way that the inflation is occurring right now. We have a lot of inflation that's literally exported. The Fed exports it through currency wars. Other countries like China, India, Brazil, those types are trade partners that are running trade surpluses with the U.S. and pegged to the dollar. Those guys are still voluntarily importing the inflation that the Fed creates. And it takes some time for that money, which is pegged to and their currencies are pegged to the U.S. base money supply. And it takes some time for that inflation to work its way through the global supply chain. So that could take, after QE2, where China nearly hyperinflated because it was growing way too quickly. They nearly had a hyperinflation type scenario. I believe food prices were at one point after QE2, they're rising, I think, more than 20% per month. It was pretty insane. And then they intentionally slowed down their economy. They started taking money rapidly out of the economy. They announced they wouldn't do any stimulus for a while, et cetera, et cetera. So this is very interesting here that we go. It's kind of, if you study financial history, you see bits and pieces of things from the 1920 to 23 event in Weimar, Germany, where there was deflation scares and the central bankers were worried about deflation because prices dropped, 60 or 70% in a year span, and then the central bank massively printed again. So these are types of, and it's been like, it was like that too in 1790 in France too, where there are different types of QEs and the money was backed by real estate with the Assignat. So it's very, very weird right now. There's a lot of volatility in the markets. It depends on people's definition. And what is your guys' opinion then on the general stock market then? I mean, you just look, right? You see dividend yields. People are overpaying for dividend yields. I think Coca-Cola is trading at a 17 or 18 PE ratio now, but it's forward PE ratio, guys, because there's no growth. There's no revenue growth for a lot of large cap dividend stocks. Coca-Cola's forward PE is like 30s, over 30. It's just insane. And, these types of things normally signal a market top, but if Ben's going to keep devaluing the currency, right, doesn't that mean then that all the assets have to rise on a nominal value?
Yes, it does. But in real term, the asset doesn't rise in value. If you factor in inflation, then the investors are getting negative returns on their investments. I would be surprised if we do see a crash this year. Mainly because the Federal Reserve just rolled out 2 QE in 2012. Mm-hmm. So
yeah, I only think, Mo, that I don't think a crash would come here from the United States. I think the only type of way a crash scenario, like you said, could occur is if Europe breaks up, like the euro breaks up, and I don't see that as of right now happening. I mean, I'm not sure exactly how much money they printed at this point, but they haven't had to print that much. They haven't had to print nearly as much as the money as they said they would. So the euro possibly breaking up, or a large country like Italy or Spain being allowed to fail maybe. And even then, I don't see them being allowed to fail. And then there's Japan. So Japan is a total basket case. Japan in the short term is actually even worse than the U.S. Japan has run, things have just changed recently for the worse in terms of how much they're going to start rapidly devaluing the yen after these elections in the last couple weeks.
Yeah.
And
I was going to say, yeah, I think Japan is the next in line. I think it's Europe, Japan, and the U.S. is saved for last. Japan, I think they're in a pretty bad situation too. Like, I understand that their credit, their bonds are owned by their own citizen, but unfortunately, because it's all owned by or most of it's owned by their citizens, that means there's more political demand to pay it back. And now that they're all consumers, none of them can work, so they can't get revenue from anywhere. So pretty much because of their age demographic and a lack of a youth in Japan, they have to print money to pay back their citizens. So if you ask me, it's sort of like a Ponzi scheme paying these Japanese back. So unlike the U.S., I think the same situation, even though they're creditors, is forcing them to print. And in terms of the big, large caps, another advantage they have, they can pay these massive dividends because they can borrow so cheaply. And then some of the CEOs still own stock, so they can borrow it cheaply, and it just goes right to them in dividends. So it's a unique situation. Like Philip Morris, they own a lot of their shares, and they're continually buying them back. So it is in their interest to pay big dividends.
Yeah, I think it's been a weird for a lot of the large cap companies, like you mentioned, John. The cost of borrowing for them, because they have a large asset base, like a General Electric or Coca-Cola or Philip Morris, like you said, they can borrow as much money as they want, basically at 2 or 3% interest, right? Because of their asset base and their cash flows, and that's offsetting to some extent the input cost rising, the inflation in the global supply chain. So that's probably why some of these companies have been able to keep up, increasing their earnings despite their revenues staying basically flat. Their revenues haven't really increased at all for 3 or 4 years, some of these companies, and their input costs are going up. Because normally, guys, when your revenues are flat, your input costs are going up, right? It means really bad margin compression, right? And if a company is going through really bad margin compression, like horrible margin compression, and you don't see any way that they're going to figure out how to control the costs, right? It's not a good time to own the company.
And that's the biggest problem with most of the companies out there. That's the input costs that keep going up year after year, and how they can cut it down. That's going to be the biggest challenge for probably the next 5 years, because of ongoing money printing and inflation and currency devaluation.
If you're a consumer staple stock, Mo, I mean, like, and you sell, for an example here, like Johnson & Johnson soap, I mean, you're going to give them, your consumer, less soap, right, to save some of your margins. But, like, if you're a commodity producer, you just got to hope then that the commodity price goes higher. So the commodity guys, and this is where I see this first, and the people say that there's only deflation now, they have not looked at the conference calls. You need to go, if you don't believe us on inflation in the global supply chain, and really the evidence is overwhelming about this, that the real inflation rate globally is well over 5%. Go look at conference calls, okay? Go read the transcripts, go look. Go look at the large companies, go look at what they are saying about their costs. Look at the mining companies in developing countries. Some of them in Argentina and South America, their costs are going up more than 10% per year. In the oil industry alone, according to the Bernstein study, and the oil industry is global, John, right? Because the supply side is purely global. It's all over the world. And Bernstein, which is an investment bank on Wall Street, did a very, very thorough study earlier in part of 2012. And they concluded, and they looked at over 50 total oil companies, that the input costs have risen by more than 10% year over year. So that, to me, says inflation. And, we do have some deflation, not using Austrian definitions, but we have some deflation, some free market forces in certain types of things. So we have some deflation maybe in consumer discretionary. You see stores like Joseph A. Bank, which I think a suit used to cost at Joseph A. Bank, one suit for like $700 or $800 from what I remember 4 or 5 years ago. Then after the 2008 crisis, it was buy one suit, get two free for the same price. And now I think it's buy one suit, get three free for even a lower price. So you're getting their margins are just compressed, and that's a discretionary item. And then you look at, another discretionary thing. You look at some restaurants like the Olive Garden, which is obviously not quality Italian food except for like the soup and salad. And you just see that in order to get customers in the door, guys, because the American consumer, their discretionary income is being zapped, they're underemployed, their purchasing power is being taken away. I don't know, 6 to 10% per year due to inflation. That's the inflation rate right now. And just to get people in the door at Olive Garden, it's buy one entree and you get to basically get one free. So this is not the sign then that you should be buying stocks like these, right?
Yeah.
You're right. But for investors out there that need a constant return on your investment, the best way to do that is look at the dividend stocks like the oil company, the consumer staple stocks like Johnson & Johnson. Even though the economy's not doing well and the company's not doing well, they're still paying a pretty good dividend yield compared to the Treasury bond market, which is 1.5% or below 1%, depending on what year you're looking at. So for investors out there that still need a constant investment return, those dividend stocks are still a good buy, I think.
Yeah, the dividend stocks, to expand more on that, Mojan, you guys can chip in here. Some of the sectors I like the best for 2013 are materials, which are specific commodities, and I don't like every single commodity. Great. I think obviously certain commodities will outperform others. I like energy, specific energy. I don't like coal that much, although I think coal can bounce pretty nicely off the bottom as a trade. I like healthcare because I think Americans are getting pretty fat and sick, and a lot of them are unhealthy. So I think healthcare is a pretty good place for dividends. And then consumer staples and maybe utilities or those types of things. Consumer discretionary, surprisingly, and the bank stocks did very, very well in 2012. I don't see them having long-term big runs here. Well, maybe the banks, if they're not going to value their assets, right? If they're not going to be allowed to value their assets, honestly, maybe the banks then. But I don't see I see the U.S. consumer and their discretionary income as a long-term fundamental trend that's going to be in decline.
Well, I also wanted to say another thing. Not all costs rising are due to money printing. Another cost that's rising is one example. Just the sector I follow the most is oil sector. In order just to drill a rig in the U.S., you have to get approval from the Department of Interior, Commerce, Development. You have to get state and local, the EPA. Department of Energy, it just goes on and on about how many approvals you have to get, the compliance cost, and the thing is regulations aren't just control, but they're also a means of increasing revenue, because the more regulations you have, the easier it is to give out fines, and that is one thing you can just make an empty promise and raise revenue through fines instead of having to directly raise their taxes. So that is one trend that's also going to increasingly happen. And I think when you're valuing a stock, are they politically well connected? I know that's sort of
or they're geopolitically diversified, John.
But a U.S. discretionary just connected too,
Oh, like a GE, the ultimate crony?
Yep.
GE has built many billions in profits and didn't pay a dime in taxes. After
Philip
70,000
Morris.
Yeah.
Philip Morris is another one. So you're going to have to evaluate how well they do with governments, because those regulations, they will be selectively enforced. They won't be equally enforced.
Yeah, and rising input costs come from mainly three things: taxes, regulation, and currency evaluation. And it's all done by the government. And that's probably the only thing they're good at, making things more expensive than they should be.
But that's what the Keynesians want, though, right, guys? Isn't higher prices a good thing for the economy? Doesn't higher prices create more jobs, and doesn't it force workers to get higher pay?
Yeah, $140 oil worked out great.
For listeners out there, I was being sarcastic. That's exactly the minimum wage laws argument, and obviously that hasn't worked out so well. Okay. Well, let me transition topics here for you guys, and you guys should weigh in on this. Okay. What do you see? We've already talked in a lot of podcasts about our views for the macroeconomic situation. How we see worsening stagflation in the developed world, so like in the U.S., the U.K., Japan. That's the goal of the central planners, is to keep things in a tolerable stagflation. Okay. Now, do you guys see anything changing that in 2013, or do you think that they're going to be able to keep things in a worsening stagflation for at least a while longer?
I think my theme for 2013 is more the same compared to what we had in 2012. I think stagflation will still be here in most of the developed countries like the U.S., UK, Europe, China.
Japan's about to get bad stagflation if they're lucky. If they can't control things, it's going to get even worse than that.
Yeah, and then the minister is talking about having a 2% inflation target, and he's already talking about spending trillions on new infrastructure and stimulus and et cetera. So yeah, they'll be lucky if they get stagflation. Hyperinflation in that country is well around the corner. So I think 2013 will be more of the same for the global economy. I don't think we'll have a black swan event yet. But you never know
It's
because it's hard to predict these kind of things.
yeah, the black swan. I don't know if we're gonna see that or not. But if we do see a black swan, I don't think it's going to be in the United States, guys, because the U.S. has already recapitalized a lot of their banks compared to Europe. Europe's banks are not recapitalized at all. So besides Spain and Italy possibly being allowed to fail, which I don't see happening, the euro breaking up, there's also the banks in Europe which are not recapitalized at all. Which one of them, if one of them goes, it could take the rest of the European banks with them, and the American banks would be in a little bit better shape because they've been recapitalized. So those are things to look out for our listeners. Japan is also a potential black swan. I really don't see any other black swans other than potentially maybe Israel invading Iran, which another one of our podcast guests in the last few months, Michael Pinto, is actually predicting that Israel could invade Iran by April or May. And he's predicting $170 per barrel WTI. I mean, if Israel did invade, we would see oil prices that high, but I just don't know if Israel's going to invade because I don't know if Obama is going to support then Israel. So those are potential, I guess, black swans. Maybe another, Fukushima type event, but because there is a lot of those nuclear power plants that are in Japan, and there's even some in the U.S. that were not built up to proper safety standards.
Yeah, I'd be surprised if we see a war in Iran. I predicted that actually beginning of 2012, and obviously I was wrong. A lot of people were wrong on that.
Well,
actually.
Obama didn't want it. I don't think Obama was going to support Israel to do that. I think that was why.
That and I don't think he wanted a higher oil price as well. So that would make the middle class very irritated at
right.
him.
You could have lost the election just on higher oil prices. You're right about that. Yeah.
So he'll be like another Bush. So I don't think he wants that. So I'd be surprised if they invade Iran. But if you look at history, every time there's a economic depression, what do all governments do? They go to war so people could forget about it, and it quote unquote, it stimulates the economy.
Yeah,
so
normally.
You never know.
Yeah, normally, like what Gerald Salente says, normally these things progress during certain stages. You have a currency war, which we're in now. Like there was a currency war in the 1920s and 30s. You have trade wars, which in the 1920s and 30s were very high tariffs. Which Smoot-Hawley was a retaliatory tariff on foreign goods. It started penalizing Japan and Germany very heavily, and it hurt their economies. So, I don't know. We don't have massive tariffs yet up there, but if we started to see tariffs on foreign imports and things like this, like if the U.S. did something like that on Chinese goods or something like that, that could really hurt China's economy. Currency wars and trade wars, then resource wars. Maybe maybe oil gets shut off from one country or another country, and then perhaps, obviously not a year from now, but sometime in the future, then Kyle Bass might be proven right. We might have a real conflict, a real World War III.
Well, I was going to say, we do have, the beginning of trade wars in the alternative energy market. The U.S. has just banned Chinese solar panels from entering the U.S. market. I'd say that happened a couple of weeks ago. There's been anti-dumping complaints and everything, and and Europe is starting to do that with China too. So we're starting to see beginning of trade wars, if you ask me. It's nothing really major. I think China would be more than happy to use their own solar panels, so I don't think it's that big. But it could be a beginning of a trend.
So you guys see then the developing world, which is our creditor nations. The U.S. is the countries that run a U.S. Trade surplus against the U.S. You see those guys then having very minimal problems with continuing to import 10 or 20% inflation then per year to maintain their pegs because the trade-off is jobs. They get to keep jobs there, and they get to rent a trade surplus and invest the money. And you see them still maintaining the system and then buying physical gold. Sometimes maybe shorting the paper market, but maintaining the status quo, the current world economy, and then just buying gold or oil or those things like with what China is doing?
Well, if you look at the trend, that's what's been happening. A lot of the other foreign countries are buying a lot of gold. They're reducing their treasury bond holding. They'll still buy it, but it will be less than what they've done 10 years ago. If you look at China, they're exchanging some of their treasury holdings for natural resources, and they've been in Canada and South America and Latin America buying up oil, gold, silver, base metal, and stockpiling them for future uses. So I still think China and India will still support our economy. Otherwise, this country won't have that much to consume because we don't manufacture that much here anymore.
Yeah, I think they'll still, like, I still think a lot of Austrians will disagree with me, but I have a different viewpoint from energy, but I still think China will support the U.S. for the next couple of years. Main reason is China has a ton of shale gas, but they don't have the technology to unlock it, and they need the U.S. Companies' technology. And the right now, I think they're still willing to do it just because they're trying to diversify out. Because I know one day they'll get the technology, but they don't want the U.S. I think they're doing it in plain sight. But for the next, I would say, year or two, I would say a couple years, they'll still prop up the U.S. some just so they can get the technology, fracking technology for the shale gas.
That's an interesting point, John. And you guys both mentioned commodities, and I mentioned commodities a little bit in the past. So let's talk. Our listeners are very familiar with us. We interview a lot of natural resource guests. We thought that's the best asset class over the long term to be long in. So let's talk about the commodities bull market here. Let's talk about maybe some specific commodities, supply, demand. Has the commodities bull market changed a lot in your view? You guys have been investing for a number of years now. The commodity, well, let me just say my view first, and then you guys can tell me what you think about it. In 2008, when I started following the markets a lot, it seemed, the markets crashed, and almost every commodity producer was on sale, and I kind of knew that the Fed was, I had started reading some Austrian School of Economics, and I realized that the Fed was going to inflate. So I knew stocks were going to go up, I knew commodities were going to go up, I saw China's stimulus plan in effect, so I knew China was going to spend a lot of money to build things, et cetera, et cetera. So do you guys see the commodities bull market, do you see all commodities rising with the real inflation rate, or do you think now the commodities bull market has changed drastically really since like the last couple of years?
I think the commodity that will do well this year will be precious metals, which is gold and silver. Mainly because both of these metals are historically been used as money, and if you look at the demand for these metals has been increasing year over year. And you mentioned to me before we started this broadcast how the Brazil Central Bank had doubled their holding in buying gold in the past month.
And since August, they've doubled their physical gold holdings. South Korea is buying massively. Almost every developing country central bank now is involved in buying physical gold. So you have the situation with China and Russia where those guys are putting more than 50% of their trade reserves into gold, and they're not allowing any gold mines to leave any of their gold mining production. And China obviously is the number one gold mining producer in the world. They're not allowing any gold production to leave the country, and Russia's not allowing any of that. So this says to me a clear message. This is a vote that long term they're voting against the U.S. dollar and the U.S. Treasury market, right?
Yes. So anytime you see central bank buying precious metal, that's a vote against the dollar. So as regards to precious metal, I still think I think they'll have a better year in 2013 than they had in 2012. And a lot of people are disappointed on how they have been doing since in the past 2 years, pretty much in the consolidation phase. But that's normal in any bull market. And if you look at any bull market, not everything goes up every year. There has to be a consolidation phase in the middle of the bull market for people to digest their gains, to take out some of the weak hands in the market, which are the speculators, the momentum traders, the people that don't look at the fundamentals of the gold and silver market.
They just look at the chart, yeah.
Yep. So you gotta clean out the system before it takes another ride to the all-time high. And I think 2013 should be that year that gold and silver do better, and hopefully. I won't be surprised if gold hit 2,000 this year, and I think silver should be at least $45 this year. I don't know about you guys, but that's my thoughts on the precious metals market.
And Mo, what other before we start talking with John here about the commodities John likes and why, what other commodities do you like then besides just gold and silver?
I'm bullish on the oil market. I still think it'll be in a wide trading range in 2013, but that doesn't mean people shouldn't accumulate holding in oil companies, oil stock.
Best dividend yields of any group of stocks.
Yep.
By far.
Yep. Then people that need a constant return on investment, so dividend stock for oils are a good way to go. Like Chevron and
Total,
even the MLP, oil trust.
Total 6%, Shell over 5% dividend yield. Those are very quality companies too, and natural gas exposure.
Right.
And they have. Go ahead.
Oh, sorry. Go ahead, John.
I was going to say, yeah, and Royal Dutch Shell has a lot of exporting, so it's not like the producing stocks. It is like what a picks and shovel company would get revenue-wise.
Okay, so,
right.
So what other commodities, Enmo? Before we interrupt you, sorry about
that. For the one commodity that we haven't mentioned yet, the rare earth market. Now, the rare earth market hasn't done very well in 2012, mainly because...
That's an understatement. Is that most of the stocks are down over the last 18 to 24 months. They're down like more than 90%.
Yep. Yep. It's like the companies like Molycorp and Great Western hasn't done well, and Molycorp is like supposed to be the leader in that industry, and it's not doing very well. So a lot of people have become very bearish on rare earth. So I think
the contrarian in you.
Yes. Yeah, exactly. But I think in 2013, I think rare earth will have a better year in 2012. I'm not saying it'll be like we'll see like 200% increases in all these stocks, but I still think companies like Molycorp will perform better compared to 2012, mainly because they're about to go online with their phase 1, hopefully this year. So once they do that, they'll get some momentum and people will start gaining interest back into the rare earth market.
Yeah, I think increasing revenues and earnings will start to bring people back into the rare earth market. Mo, do you think 2013 will be good for uranium, or do you think 2014 then?
I think uranium is a good long-term play. I don't know if we'll do well in 2013, but I think within the next 5 years, I think uranium will be a good investment. We've spoken to a lot of natural resource experts, and a lot of them say that uranium is bound for a rebound, and it's going to be in a bull market, because if you look at what China is doing, they're building a nuclear power plant every year, and I think they're trying to roll out double-digit nuclear power plants every year going forward, so that's very bullish for uranium. Japan's still going to be using uranium no matter what they say, because that's the only type of energy they can use, because if they try to go to another type of commodity, that's going to be very expensive for and it's going to affect their trade account, and it's going to make their spending deficit even worse, because they have to spend a lot of money to make that change.
Yeah, so that might be a trade idea then, to short short the yen and then long something else that Japan's going to invest in for energy. Now, John, in terms of your views of the commodity bull market, what do you see with the commodity bull market, and what are your views on that and some of the energy picks, and what not specific companies, but I mean which energy types of energy commodities do you like, and just talk about all the different types of commodities you think will do the best in 2013.
I think oil will do pretty well, and the main reason is I think it's going to be pretty volatile because of that petro business cycle, and basically what it is oil price is low, people have extra money in their wallets, they start investing, they start consuming more, then demand picks up, oil goes high, then eventually expenses go up, people start spend a lot less.
Demand destruction in the developed world, yeah.
Yeah, so I think you're going to see that. I think with the geopolitical tensions and everything, oil will go up. I don't see a 170 spike or anything. I think it gets up to 125 unless there's like huge geopolitical tension, war tensions. I would take some profits. If you even got up to like 118, I would definitely take some profits and wait for some correction, just my opinion. But I think oil will do well. I think China is doing the stimuluses again, QE3 and 4, and if they do another one, that was the biggest lie a couple of days ago. The Fed's not going to end QE in 2013. So many banks would go bankrupt. QE3 was, if you ask me, all it was a disguised bailout, so no one would notice. That's all it was. And then QE4, there's no way they're going to stop buying Treasury debt. Interest rates, if they went to 4%, it would be the biggest expense we have, more than Social Security, more than Medicare, the military, or anything. So they're not going to stop buying.
For every 1% increase, John, increases the interest payments on the national debt by over 150 billion. By over 150 billion. So 4% rise, like you said, would be a $600 billion increase per year in the interest payments on the national debt. And the problem with the debt is that it's growing at a compounded annual rate of 11% right now. So it's going to and this is assuming no more spending, guys. That's the scary part. And the government is, even with the fiscal cliff stuff and all the other stuff, there's no real cuts. Even the Ryan plan, which was called draconian and all these other names, blah, 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 right? It was just a decrease in the increasing rate of spending. Guys, we're gonna the dollar is gonna be the main destruction here. The purchasing power of the dollar. Not that any other paper fiat currency is good here, but okay.
Oh, I was also gonna say I also think a contrarian way of playing inflation is natural gas infrastructure, because as oil goes up and all the other energy thing goes up, not all energy, but alternative energy is already expensive. Natural gas will remain cheap because of the gluts in it, and not only that, there's a lot underground that's not economical, but as the prices go there, the market will flood again. So you're going to see a lot of pickup for natural gas vehicles, cars,
I see higher trading
tankers.
Ranges for natural gas. Like, for the reasons you just said, I see higher trading ranges, because every time the price goes up a little bit for natural gas, more supply comes back online, right?
Yep. So I see cheap natural gas.
Do you think it's a good time then? Because I'm sure our listeners want to know about this, because they just see Chesapeake Energy down so much and some of these other guys. Do you think it's a good time to buy these natural gas stocks, or do you think their balance sheets are in such disarray because they've had to write down they have so much debt in their balance sheet, they over leveraged it, they can't make a profit producing gas at this cheap. They're lucky enough to sell it forward, and they've had to write down a lot of their reserves because some of their reserves were only economic at $5 gas or something.
I own natural gas, but I don't own the producers, and I would stay away from the producer. I own the tankers. I think those are the safest, easiest way to do it. I own just tanking companies. One growth, one that's supposed to be the leader, and I'll just say what they are: Golar, Gaslog, and TK. They're both great companies, well run. Two of them are just for dividends and growth, and then the other one's for growth. They have the best technology. That's Gaslog. I recommended that in my interview with the Money Show. But also, so I think there'll be cheap natural gas. I would not go into because they're going to pass more regulations on fracking, whether it's dangerous or not. I'm not really one of those big, it's horrendous thing. Every energy has its problems. Fracking's no different. But basically, the anti-fracking movement, that's funded by OPEC, and it's funneled through, if you ask me, it's already been proven Dubai has given money to Matt Damon's new propaganda film, Promised Land, so to stop fracking.
So then you expect then production costs to rise for shale natural gas for anything using fracking then, and that's going to put, a higher price floor each year?
Yeah, and I would say, but the fracking producers will have to comply with those regulations, so their costs go up. And Dubai is interesting because in the Middle East, most people already know this. No one fights in Dubai, and I think that is the one area where all the surrounding countries can funnel funds there to help support the fracking movement. So I don't think it's just Dubai. I think the Saudis, Iran, all of them are funneling funds, and that way they can funnel funds into the U.S. to stop the anti-fracking movement, and it wouldn't be traced back. It would just be traced back to Dubai.
Yeah, I mean, there's a lot of crazy lobbying, guys, that goes on. We're right outside of D.C. There's a lot of crazy lobbying from foreign governments to get subsidies and get certain political agendas across here in the U.S. that most people wouldn't even guess.
Yeah, and one other thing, uranium. I love that commodity. One thing, I think the uranium stocks are going to really outperform the uranium energy price. And the main reason is this is what we, Mo, Jason, and I always say. When buying a stock, you want to look at management and people. Out of all the energy companies, uranium, I would say even including gold and silver, especially gold and silver, uranium has the best management, just in generally speaking. Nolan Watson, he's a great manager no matter what sector he goes in. He could be the best no matter what, but just generally speaking, with good management, these uranium companies survived the '08 crash, Fukushima, the threats of Europe.
They had their uranium bubble before that too. They had their uranium bubble before the '08 crash too, John. So they had they got whacked even more when the stock market crashed. In 2007, the uranium price I think spiked from like $20 a pound to $130 a pound very rapidly, and then it crashed. Yeah, and then their market blew up like rare earths. So they've been through a lot of bubbles. Yeah, so they're battle tested. They're lean and mean.
Yeah, and not only
lean
that,
and mean.
Yeah, Amir Assad. I remember I bought his stock, Uranium Energy Corp. I bought it in the summer. The uranium has just been flat the whole time, but his has already gone up from 190 to 260. So that's all management, and I think the uranium stocks are really going to outperform uranium this year. Uranium, I don't know how much it will go up. I think it will go up because megatons of megawatts and Putin's infrastructure projects are going to drive it up, but I think the stocks are really going to outperform.
Yeah, I think 2013 should be a pretty good year for uranium, but I think 2014 is going to be that real sweet spot unless we have a global total economic crisis where a big bank or a sovereign is allowed to fail, or there's another Fukushima disaster or something like that. But once 2014, John, shouldn't more of the Chinese nuclear power plants be online by then, and the megatons to megawatts then is fully over by then too, right?
Yeah, I would say so.
Yeah, so 2013 then, maybe our listeners should start doing some extensive research on uranium, maybe start accumulating a little bit of a position here or there, and get ready for 2014. John, do you have any other opinions on the rest of the commodities market? Are there any other commodities you have an opinion on? For example, the soft commodities, you guys? I think I think the softs are just they're gonna have their corrections here and there, but as the world population, stays at least at 7 billion, unless we have a world war or something like that, our population is going higher. So I think then that's going to put tremendous supply pressure, tremendous demand pressure on the supply of softs. Because, a lot of these soft commodities that are grown, they just can't be saved for years and years and years. They have to be replanted, and if demand increases, it's very tough to increase supply so rapidly.
I agree with that, and one of the best ways to invest in the agricultural industry is the fertilizer industry, like potash, which is in high demand because the farmers, they don't rotate their crops. What they use is because of the technology we have, they use stuff like potash fertilizer to regrow a crop on the current land that they have now. So and potash is in increasing demand, and I think that's something investors should look at if they want to get exposure to agriculture.
Yeah, Mo, I'm glad you brought that up. I'm actually pulling up right now a chart, a 2-year chart, because this chart has only been in existence. It's an ETF for the fertilizer companies, the potash producers, called SOIL, SOIL, rather than just looking at POT. And the stocks really haven't done a lot for 2 years. We were talking about the stocks a lot. We got a 10-bagger at one point a few years ago in Alana Potash that went from 30 cents to around $2.50, $3, so just about a 10-bagger before the stock rapidly corrected. I really like that company again for the long term. That's a junior pick as they build their mine now, and then they're going to be making $300 million a year once the mine is in production. But I'm looking at this soil ETF right now, the 2-year chart, and it's had its corrections here, and it looks like it's built a really nice base, guys, and it's about ready to move higher.
Yes, and yeah, I agree with that.
It's making higher lows. Yeah, I'm looking at the trend line now in the chart. It's making nice higher lows. It's corrected a couple times pretty badly, but it's starting to make higher lows, and it's starting to, the fertilizer ETF is starting to move higher. So I think that's a good thing here, because potash has underperformed for 2 years now. So
yes.
it's due, because as food prices rise, right, the farmers are going to want to plant more crops, right?
Yes, that's what I heard too. And as you mentioned, because of the increasing population that we have in this planet, there's no reason why potash stock should not go up in the long term. As long as people need food, which is never going to stop, potash investment is I think is a safe play.
Yeah, I think that's good too. And there's some pretty good potash dividend stocks. There's a few MLPs that I know John likes. We don't have to mention the specific names, but you could buy Soil. Soil pays a dividend. POT, Potash Corporation, pays a dividend. I think Mosaic pays a dividend. I think Agrium pays a dividend. And there's a couple other ones too. Can't name them off the top of my head. My memory is not that good anymore. Okay, so let's wrap up then the commodities bull market, guys. So you really like specific energy plays over the long term here, and 2013 should be a bounce back year for oil. Precious metals obviously are our favorite. We think those are going to still probably lead the commodities bull higher, maybe along with softs. I think the softs have a really strong demand in them because the people, because of the world population growth, one of the first things that people do, right, is they want electricity in their homes. Maybe they want some gasoline. They want a car. They go out and buy a cheap car if they're in a developing country, or a scooter or something, right? So they're going to need fuel for electricity and for transportation, and then on top of that, they're going to want more calories, right? Because if they're just, a cheap Chinese peasant back in the even a few years ago, and they just started getting some money in their pocket, they're probably going to want to start eating more protein.
Yeah. Yes, and there's one thing we haven't covered. It's the gold and silver mining stock. A lot of people have been frustrated with that as well, and we haven't touched on that subject as well. What do you guys think the precious metals mining stocks will do in 2013?
Well, the industry really needed to consolidate. There was a lot of mismanaged juniors. Canada and Vancouver specifically is very good at, as Rick Rule, one of our guests, said, counterfeiting. Okay, there was a lot of companies that should not have gotten any money, going out and raising 10, 20, 50 million, some of them more than that, to drill holes, and they wasted a lot of money. Those stocks, they may have found a deposit, they may not have found a deposit. The management teams of some of those companies are geologists. In a lot of cases, they didn't have all the different right skill sets on their board of directors or management teams to get the deposit further along, to move it all the way up the stages there, like pre-feasibility, preliminary economic assessment, feasibility, start raising capital, build a mine. So, the industry, the stocks have not performed to the level the bullion has. There was a few stocks that obviously did. The royalty and streaming business model is by far the most efficient. Those are going to do very well. Those can generate free cash flow during really any type of business thing, unless the precious metals dropped massively, which I just don't see a drop at this point, because I see basically a Bernanke put. I see a central bank. Let's label that a central banker put. Because let's not just single out Bernanke, because it's every central banker, guys. Right now, it's almost
very coordinated now.
Yeah, it's a coordinated effort.
Draghi, definitely.
Well, even the Japan guys now, they're going to start inflation targeting, like you said. So I don't really see gold going below. I don't even think we'll see $1,300 or $1,400 gold again. Triple digits gold, in my opinion, unless an absolutely free market force with a large bank, a Lehman type event, or actual sovereign allowed to fail. I don't see the markets going that low for gold and silver. I actually read a very good, credible article with a lot of good insights into the mining industry that was showing production costs, and it said most gold mining companies, because the grades are so low, the production costs are rising every year, and a lot of companies like Barrick, Goldcorp, Newmont are mining much lower grade deposits. They cannot make money now below $1,300 an ounce gold. So that would seem to me then that if gold dropped below that level, you'd start seeing either mines not get financed, no matter how close they were to production, or mines that were in production would start getting shut off. And then the same goes for silver around 28, 29. So I think we have new price floors in there, and the industry is just going to have to be more efficient. They have not created, except for the royalty and the streaming companies and a few select companies like Keith Neumeyer, right? Keith Neumeyer, First Majestic Silver, who I think is by far the best CEO in the silver industry. They just have not done a good job with acquisitions. So when like a Barrick wants to make an acquisition, right, they wait till their share price is high, till the gold price is high, and then they overpay for a junior deposit. They massively overpay, and then by the time they're ready to build the mine 5 or 6 years later, first of all, the mine's not ready to go into production immediately, and then they massively overpay for it, and then there's just humongous cost overruns, billions of dollar cost overruns. That's not efficient use of your capital. That's not treating your shareholders well. The best values right now are the guys making money already, right? You can buy earnings and cash flow, right, from the producers at a very low valuation, a very low multiple.
Yeah, and there's a lot of bad management out there in the natural resource industry. That's one of the things that's very, very frustrating when you invest in like the mining stocks. And the people that they get funding to get their mine in production, and instead of doing that, they go ahead and try to exploit the land more, and they waste their money on drilling for more holes instead of trying to get the mine online so they can have a constant cash flow, and then they expand. So there's a lot of mistakes going on out there. A lot of people mismanaging their project. It's very frustrating. And Kinross Gold and Barrick Gold had fired their CEOs. And, these are major gold producers.
Well, Kinross made 4 or 5 bad acquisitions, and I think they massively diluted their shareholders, so that guy deserved to go.
Yeah, he did.
Yeah, I think the mining stocks will do well. You always got to do your management homework, because there are mining stocks that they get rich at the shareholder's expense, not with the shareholder. So they do it, and they're good at it, I will say. It's probably where the central bankers learned how to print. But yeah, Keith Neumeyer, I can always sleep well at night. Goro, I think they've done a good job trying to do. They've missed on some estimates, but they're trying to keep shareholder value. They're even paying in bullion.
They're buying back their stock massively too.
So I think Gold Resources, they're doing a good job. Of course, Nolan Watson he's like the creme de la creme. So
Keith Neumeyer too. Don't forget Keith. The first
I
Majestic
thought
Silver.
I mentioned him,
The first Majestic Silver, whereas some of the other management teams that have cash flow were not aggressive during this correction phase here and going out and buying good assets for pennies on the dollar. Keith did 2 really smart acquisitions for very low valuation multiples, in my opinion, that have created massive long-term value for his shareholders at First Majestic Silver.
Yeah, I've been buying that for December. I was really excited about it.
So we're pretty much on the same page regarding how the mining stock will do. We'll see what happened in 2013.
Yeah, I think we could go sideways, guys, for another couple months. You think we could go sideways maybe for 6 more months? But I think if we go that much sideways, I mean, input costs for a lot of the miners are still rising each year, right? So at a certain point, the miners are just going to say, we can't continue to produce at these levels without the price going higher. So I think there's catalysts, though, for the mining stocks. I really do expect the gold price going higher because all central banks now are starting to load up on gold, and then you have Basel III, which is just going to switch the incentives for a lot of the banks. Instead of leasing or swapping out gold or shorting it on the paper market, it's going to switch the incentives then for them to start buying physical gold and putting it in their balance sheet because Basel III with the Bank of International Settlements, now they can use physical gold as 100% good collateral, whereas in the past it was only 50%. So that'll improve their balance sheet if they buy and hold physical gold, and then it's an undervalued asset right now.
And when did that go into effect?
It just started now.
It just started? Okay.
It just started now. So that means then that banks are going to be allowed. It started effective January 2013. So you're going to start seeing banks now who may have never owned any gold in the past or who were short gold, leasing or swapping it out on the paper markets. You're going to want to start well, not you're going to want to, but we're going to, in my opinion, start seeing banks then start going long gold now. Because, in effect, what the Bank of International Settlements people have ordered, Mo, is kind of a return then to the gold exchange standard of the 20s, which is where the banks, the central banks and the regular banks could have their reserves in gold. Whereas in the past, in the recent past, they weren't allowed to do that. So that's the type of monetary situation we're going. They're trying to, I guess, get the banks then and some of the central banks away from holding as many treasuries and other lower quality assets that are not as good as they sound on paper.
Yeah, I was gonna say the Basel III will it pave the way back to the gold standards? That since the bank will now be
Well, I don't know
instead of
about
instead of
a full
to
gold standard. I
gold.
don't know about a full gold standard because even then with a full gold standard, the politicians can obviously figure out ways to cheat around that because in the past that has happened many times in the past where politicians and kings and stuff have cheated on the gold standard. But yeah, I mean, gold's being remonetized, right? Do you guys agree that gold's being remonetized by the banking system and the market then, to a certain extent?
So
Yeah, sure. Go ahead.
I would say to an extent, yeah.
Yeah, I agree. Because you're seeing a lot of central bank buying more gold year after year, so that tells you that they want to keep the gold in their reserve in case of a total collapse in their own currency.
Well, when it comes to buying, there's only one reason someone buys anything. It's because they like it. And if central bankers are buying gold, there's a damn good reason they're doing that.
Well, I don't know about that for central bankers, John, because most of them are Keynesians and they're so anti-gold. But if the Bank of International Settlements, who is their boss, right? If that's the central bankers bank, if they get ordered to buy gold, then they will.
Yeah.
Yeah.
Well, who knows? There's that Fisher guy, and I don't know.
The Fisher guy is the Dallas Fed president, though, and he's not involved, I don't think, with the Bank of International Settlements. The Bank of International Settlements is an even smaller group. But uh, okay. First, let me besides mine. So I think like sometime in the next 6 to 8 months, you guys then expect a big move in mining stocks.
Yes, I do. I expect a big move in mining stocks and in gold and silver as well.
Yeah, I expect a big move. I thought it would occur already, but what happened in the charts, the fundamentals were obviously increasing, but the charts looked really good up until a couple weeks ago, and then it looks like someone came in, probably a central bank, maybe China or Brazil or something, or maybe a couple of them came in and just shorted the paper market on the long futures contract to accumulate more physical. So that might take a little bit more time to repair the charts. But then we should move out of this consolidation zone finally after a certain amount of time. Let me wrap up my view of the commodities bull market, and then we can do maybe some predictions for 2013 Mo and wrap everything up. Okay.
All right.
Okay. So I'm pretty much in agreement with John and Mo about a lot of the commodities bull market. I think a lot of it has changed for certain commodities. Whereas all the commodities would have went up in the past. I think you got to be very careful, especially with base metals. If I cannot say this enough. So with coal and with base metals like a high-grade iron ore miner, a copper miner, our listeners, for those primary things, those are short-term swing trades, in my opinion. So if you want to speculate a little bit on a coal stock, right, because it's gotten destroyed, the stock is down 90%, maybe its balance sheet's not as bad as some of the other coal companies because a number of them have gone bankrupt, right? I think Patriot Coal filed bankruptcy. Right? There's still a certain amount of coal demand. Yes, countries are trying to cut back on it, but there's still a certain amount of coal demand, and you might get a nice pop for next 6 to 12 months or something like that. Nice little swing trade in one of those things. For coal, same type of thing with copper and high-grade iron ore. In general, those companies, though, like a lot of them, especially like Rio Tinto and BHP Billiton and Vale, they massively over-leverage their balance sheets with humongous amounts of debt to bring on marginal mines that were supplying China with all this base metals and coal, so China could build more buildings. And in my opinion, China has decided, over the long term that it's better to hold coal or better to hold copper or iron ore or oil or things like that. But a lot of this demand is really artificial because there's a certain amount of empty cities, at least for a couple years, before they get filled up and things like that. So the demand is kind of artificial, and it's not, when China decides, guys, that it wants to take a break from buying copper, the copper price could correct, solid 15 to 20% in a matter of a month or two. So those are the types of stocks where you don't want to buy and hold that in the event where China decides to take a break. You want to be the guy accumulating at the bottom of the market, like with what China is doing in their sector rotation. I like your other commodity picks there too. I think the rare earths could easily have a really good move in the next 24 months, especially as more revenues and cash flow come online. I think the potash stocks are very overdue. 2013 is an accumulation year for uranium. I really see it having a good year in 2014 unless there's another Fukushima. And Other than that, there's some other strategic metals out there that are pretty good. But the natural gas market, John outlined that really good. The safest plays in natural gas, which I think are going to be the best returns, are going to be the infrastructure plays. So the U.S. can change to an exporter, and the U.S. maybe consume some more of its own natural gas production. Anything else you guys want to add here? And then we'll talk about 2013. Any other predictions for 2013 as we wrap up?
No, I think I already gave my prediction for the gold and silver market. I already, as I said before, regarding the stock market, I don't see a crash coming, in the stock market. I still think oil will be in a wide trading range between, the $75 mark and I say $120. So anywhere between there, I'll think it'll stay between there for this year.
John, no, I don't have any other predictions. Stock market, I think, will slowly go up. Like one example is in When Money Dies, that book. Mm-hmm. That was actually during Weimar Germany. The stock market was actually the highest performing. It was towards the end of hyperinflation. A lot of people turned in their gold and silver and bought up businesses, and so the value of businesses went up big time. So I still think with inflation, stock markets do well. It won't just be gold, silver, and commodities, the traditional inflation hedges that people think.
Well, John, interest rates weren't sky high then, right, for Weimar? Because stocks can do well for the most part, right, until interest rates started going sky high, right? And as long as the Fed's involved in, even with inflation, if companies don't have to deal with super high interest rates, right, that's going to be wind at the sails for most companies, right, for their borrowing?
Yeah, well, they tried to slowly rise interest rates, but then their just currency became so worthless. The interest rate rising didn't even matter.
Well,
from what I read,
there's just so much interference in the bond market and with interest rates. In the over-the-counter derivatives market with the interest rate swaps, many trillions of dollars worth of interest rate swaps. Yeah, I don't know if we're going to see free market forces for a while. I don't see any bond vigilantes. Those guys are bought and paid for. The Fed buys them off, most of them, especially ones that would attack the U.S. I think they're more concerned with going after Europe or maybe Japan in the future. So I don't know how much free market forces we're going to be allowed to see, guys. I mean, it would be nice to see some free market forces, but we only see bits and pieces of it here and there. The last thing, guys, I want.
I just want to say one thing that is true, because I wrote an article December 8th saying the Fed's going to announce QE4, and the reason it was so easy to predict was the next meeting was in January, and if they didn't announce it then, the bond vigilantes would have shown up. So they are making sure that they don't show up so far.
Yeah, so they're front running this stuff. They're ahead of the game. They're managing expectations, and then when there looks like a disinflation period, then they feel they can do more inflation then, and it'll get exported to the people on the dollar pegs. One last thing I want to talk about, guys, and that's about the people on Main Street, the U.S. consumer. What are your guys' view on the U.S. consumer? Because we just have we've had a lot of these consumer stocks go up for a while. They have a little bit of correction here, but people keep saying not to short the U.S. consumer, not to count the U.S. consumer out. I mean, the U.S. consumer is being grinded right through a bunch of different things here. You have stagflation. You have the U.S. consumer, which their purchasing power is being taken. They might be lucky if they can find a job, right? Or maybe they're working 2 or 3 part-time jobs and barely paying their rent and food bill, right? So what is your opinion here of the U.S. consumer? Because we keep hearing on the mainstream media that CNBC and these guys that the U.S. consumer is going to keep spending. I don't know how they're spending. What are they getting? Are they switching from 0% interest rate credit card teaser things to each one balance transferring or things like that? Because I just don't see people with savings. I don't see people with getting wage increases at their job. And during a stagflation environment, and this in a lot of aspects, this is going to be worse than the stagflation of the 70s because, interest rates were higher back then, and they were signaling to people that they shouldn't be spending like that. We just see some incorrect signals from people. What is your opinion of the U.S. consumer then?
Well, I think going forward, especially the middle class, they're going to get hit hard, mainly because of the higher tax rate that's coming. The Obamacare is now in effect, so all the taxes on that is now in place. So that's going to hit the middle class hard. and the payroll tax cut is expired, so people with income up to I think 113,000 now have to pay 2% more to Social Security. So that's $200 a month that's not going into the bank account. It's going to the government to keep funding that Ponzi scheme, the Social Security trust fund that they have over there. So that's going to hurt. $200, may not sound a lot.
That's a discretionary budget, though, right? That's discretionary spending.
Yes, but that $200 could have gone to college savings or saving for a down payment on a car or a house, or paying the bill or paying for groceries. So for middle class, $200 a month is a lot for them. So I think going forward, the middle class will start realizing the majority of their budget will start going to energy and food, and it's going to get bigger and bigger and bigger. And that's what happened in Egypt, and that's what led to the protests, because a lot of people didn't have any job, or they had low wages, and most of their wages went toward food and energy, and they got fed up. So
and then the
I
price
think,
of food increased too, right, Mo? And they couldn't afford the increase, right? So they
yep.
were fighting just for their lives because they needed food.
Yep. So I think the U.S. consumer are going to have a tough battle against inflation, and a lot of them are not even prepared because they don't realize what's going on in the economy, and because the government did a good job hiding the inflation. So that going forward, I think the battle against inflation will be very tough on Main Street consumer.
Well, not only that, all U.S. consumers, they're seeing their taxes go up too with all the cost. Regulation, to me, it's just, I said this earlier, it's another form of tax, and those costs are going to be passed on to the consumer. So combined with the inflation, they're going to have a lot less to spend. But not only that, though, but their taxes are going up too. The fiscal cliff, their payroll taxes are going up. So everyone's getting a pay cut. And it just shows what short memories people have, because Obama said if you're making less than $250,000, your taxes won't go up. Well, he lied, and he's not even being held accountable for it. And I don't think anyone's taxes should go up. I don't care how much you make, but that was like his main theme. Like, if you ever elected me for president, you wouldn't see your taxes. Well, your payroll taxes have just gone up.
Yeah, I just started briefly looking at some charts here of some of the restaurants, and some of them are a few of them are pretty good, but the majority of them are just not in good shape right now, and I think that's directly tied to consumer discretionary spending. So I think if there's a restaurant ETF or something like that for casual dining, I think those guys are going to struggle the most, because people are going to still want to eat good food, but they're not going to be able to go out and eat as often, and maybe they're going to go grocery shopping more than normally when they would have went out to the restaurant, a couple nights a week or something like that. So either unless the restaurants start offering really discounted specials and hurt their margins to get people into the restaurant, which is what Olive Garden, Darden tried to do. So I think that's a theme here. Is long term, the U.S. consumer, their discretionary spending is going to be cut probably in half. Not in the short term, but it's going to be cut in half, in my opinion, over the next 7 to 10 years.
I agree with that, and a lot of it's going to be due to because of most of the budget going to energy and food for their own house.
And insurance too, and all the other staples and necessities people have to survive. Yep, I agree.
Yep.
Okay, guys. Well, that's probably about it. Also, before we go here, let's tell people about our oil report, because I think people should go and get our copy of our oil report, because I think the sector is so undervalued. They should definitely, if they haven't given us their email address, they can go and get our oil report, which we sold copies for $150 a copy earlier in the summer. The report's still very valid because the oil industry, a lot of stocks went through a correction. I think some of them are going to really start outperforming shortly. And some of them, even if the oil price stays flat, some of them are going to increase their production, or they're going to double their production, guys, right, over the next 12 months. So even if the oil price stays flat and they're making money now, they're going to double or triple their production. That's going to really move the bottom line.
Yes. So yeah, people can go to our main website, www.wallstreetformainstreet.com, and then a pop-up will show up, and they can put in their email address, and it'll automatically get a free copy of our report. And it's not spam, and we don't share your email address with anyone else. So I'd recommend they check that out.
Yep. And we're also available for consulting, either in person here in the DC metro area. They can contact us at wallstreetformainstreet@gmail.com. Or if they want to do some consulting online, maybe where they want to learn how to read a chart for technical analysis, or they want to learn how to invest in resource stocks, do research on those, or do a dividend stock screener, or look for growth stocks or things like that. That's just to name a few of the things we can teach. Some options trading. These are the types of skills we can teach people so they can survive and thrive financially going forward.
Yes, and people can contact us at www.wallstreetformainstreet.com as well. And under Contact Us, they can send us a message, and we'll reply back to you as soon as possible.
Okay, great. Well, I just want to thank you, too, for joining me on here, guys, and hopefully our listeners enjoy this. I know we ran a little bit long, but it's important. We had a lot of important things to say, and we needed to cover a lot of topics before the year starts, and hopefully our 2013, my 2012 was a roller coaster, guys. Like, I don't want to talk about all the things that have gone on in my life. You guys know some of them, but, I think my 2013 is going to be really good, and I hope you guys have a great 2013, too.
Same to you, and you too, John.
You too. Same deal also. I think it'll be a great year for the commodities.
And hopefully a great year for Wall Street for Main Street, too.
Yeah.
Yep. All right, guys. Well, for all our listeners out there, thank you for joining us. And until next time, have a good night.
And Happy New Year.
Happy New Year as well.